what we are going to talk about today is inducement. And inducement is basically everything. Like inducement is everything. Like inducement is like the market wanting to take money from when I do you know, okay, like, you know, if you're talking about gaps in the market, like gaps in the market, something like all those type of gaps, like unfilled orders and all of those things that the market creates, So, and you know that sometimes, if for the most part, if the market has gaps, that means it has to be filled, It has to be filled because it is creating an imbalance in the market, and and we know that it is the market is drawn to liquidity, and if you are talking about liquidity, we are talking about stop losses. If you are talking about stop losses, we are talking about liquidity, because liquidity equals money, and your stop loss equals money, because if you lose, you're adding money to the market, and we also know that the institutions like the pension companies and all of those companies, they've got please, can everyone mute themselves, please, so that I wouldn't get any distractions. So since we know that the market is drawn to liquidity, and the pension companies and all of those companies, pension companies, institutions, reserve banks, and all of those corporations and all of those corporations and institutions, that they control a lot of funds in the market. And you know that this supply and demand is actually kind of designed or crafted in there are some people, when I was listening to one guy that I would say, I think, he actually left he actually left smart money trading. I just checked and he left smart money. He said that smart money traders, they always like to say something like they don't have a straight meaning of a trade, like something that they might say it is from this from, like, they are trying to give a trade meaning based on a theoretical meaning. You understand? They will not just come and analyze and take a trade. That smart money traders always say that this market goes to take liquidity from this place to this gap, from this gap to this one. Like, we are always trying to put a meaning, write something relating to a trade. You understand? That's how they do, So he was kind of, like, yabbing smart money traders. But that is what we actually do. We add meaning. There is always, we add, it's like, I see supply and demand as a kind of a theory type of trading. That is why if your trading doesn't have a meaning, or if you don't have a reason for trading or taking a setup, or if your setup don't have a reason or a meaning, there is no setup. You understand? Because there is always meaning to what we are doing. And that is how our trading style is. So now, since we are talking about inducement is actually kind of a fake out. We were talking before that if in a book I read about informed and uninformed traders. So we are actually the informed traders. We are the informed traders, and other traders, other retail traders that are not us, that are not we, the smart money traders, are uninformed. Sometimes some people will be like, there are, like, we are the informed. You understand? So we are the informed traders, and there are uninformed traders. You understand? So those uninformed traders don't actually know what is going on in the market. We are the ones that actually do know what is going on in the market. And though yes, everyone trades their own style, but I feel like we are actually doing the true type of trading, because one, we are trading traditionally. We are trading price action. We are trading price action, and price action is everything. Like price action is the traditional way of trading, and that is what we are trading. And also that is what smart money or ICT is just all about. So I think that's what I have to say. And now, since there are informed traders and uninformed traders, so that means the uninformed traders, which are the retail traders, everyone is a retail trader, but sometimes we, the smart money traders, we call other type of traders retail traders, and that we are kind of the ICT, the inner circle trading. That is our style. So sometimes we call them retail traders because everyone knows we trade like banks. It's not joke, but we actually do trade like banks. You understand? We trade like the banks do trade. That is why our type of trading is you have to be like, I don't know, but you have to really think and do the right thing. You have to be plugged in. Our style is actually one of the hardest style of trading, because if you don't get it, because you're literally at the mouth of the institutions. You are drawing a zone, you are taking supply and demand zone. You understand? So you're trading where the big dogs are. So you are just few meters from the institutions. And when there are people there, when there are other traders there, everyone they would like to make some fake outs now, so that because there are other, since some traders already know what the big boys are doing, and already know what the institutions are doing, and know the zone where they are. Why won't them, which is the institutions, come to that zone to do some manipulations? They can't give you all the money. They can't give you money all the time. They don't want you to win. They don't want you to make wins. You understand? So they have to be at that point, at that key level where they trade. And because they know that you know how they trade. So at those key levels, there will be manipulations. There are always manipulations at key levels. You understand? And key levels can be support and resistance, supply and demand. If you're trading trend line, on your trend line, your Fibonacci, they give key levels. So there are manipulations at key levels, because the institutions and the big dogs will know that there are people buying and people selling every time on the market. You understand? So that is how, and then by making those manipulations at key levels, the institutions tend to add more liquidity to the market, because they always have to balance liquidity, because there is always gap in the market. So for them to balance liquidity, or for them to fill in gaps, they have to find or sort for liquidity. You understand? And traders provide liquidity to the market. When you are losing, they are going to your stop loss. You are automatically giving liquidity to the market. You are providing liquidity to the market, plus the liquidity that they have to trade. You understand? So now we already know that yes, the institutions are trading at key levels, just like we are doing. And secondly, two, they bring out candlesticks. They are the owners of the candlesticks. They brought out candlestick patterns. They created candlestick patterns. The institutions created candlestick patterns. They created all the patterns that you know. One, they created candlesticks. They created double bottom and equal low. They created double bottom, double tops, head and shoulders. All these are the patterns that the institutions created, and then told you, which is the trader, when everyone was learning, that Whenever you see double bottom, buy. Put your stop loss below. Whenever you see double bottom or double high, that you should buy and put your stop loss below or above. Something like this. They will tell you that whenever you see double bottom here, that you should buy and put your stop loss below here. And then, that is what everyone, or whenever you see a double top, you should sell because the market will be selling. This is what every other type of retail traders do know. They know that they sell at double bottom, and they sell at double top. This is double top or equal top because of this and this. Because of this and this. This is double top. Then this is, you can call.
I hope it's recorded. I hope it's recorded.
Yeah.
I hope it's recorded.
Yeah. It's recording. And this is, you can call this double bottom. You understand? And this is double bottom. So every other retail traders already know that they buy at double bottom. They buy at double bottom, which can be a support. You understand? So they buy at double bottom, and they sell at double top. They sell at double top, they go down. They sell at double bottom, they go up. You understand? This is basically what all other retail traders do. This is how retail traders trade. So if there are retail traders that trade double bottom and double top in the market, in the charts, in Forex, that means automatically there are liquidity, there are money at every double top or double bottom. Everything being equal, there is money at all double bottom. So if there are retail traders that trade double bottom or double top, it means that there are liquidity at every double bottom and at every double top. Do you understand why? Do you understand? Is everyone following what I'm saying?
Yeah.
Okay. So you understand? There is money at every double bottom and at every double top. So now, if there is money at every double bottom and at every double top, there is also money at every two candles, a green and a red together. So there is liquidity. And since when I say liquidity, I am talking about money. Because your stop loss is liquidity. Liquidity, I mean money. So if there are liquidity at double bottoms and at double tops, there is also liquidity at double candlesticks. Double candlesticks are a combination of a green and a red candle. So there is liquidity at all edges of the market. Do you understand? There are liquidity at every high and the bottom and the low of all the candlesticks. Which means that there are liquidity here, there are liquidity here, there are liquidity here. Are you following me? Are you guys following me?
Yeah, we're following.
Okay. So now we've known where liquidity is in the market. One, liquidity is at the highs and the lows. There is liquidity at the highs and the low of candlesticks. And there are liquidity at the highs and the lows That means the double bottom and the double tops. These are where liquidity lies in the market, and the market is constantly seeking for liquidity. If the market is constantly seeking for liquidity, that means liquidity is drawing the market. You understand? So now we know that there are liquidity at the double bottom, the double tops, the candlesticks. You understand? By the candlesticks, I mean that there are liquidity here. So I will represent it just like I represented the candlesticks. There are liquidity all here. Here. There are liquidity everywhere. Liquidity is basically all everywhere in the market. So each candle, all candlesticks are liquid, have got liquidity on there. All have got liquidity in there. So there is liquidity in the market, just like this. Just like this. That means liquidity is lying just at every corner of the market. Liquidity is lying at every corner of the market. There is liquidity lying everywhere. Now, since one, we know that liquidity, the market is drawn to liquidity, and the market needs liquidity to keep moving. The market needs liquidity to keep moving. You understand? So now, if you have to add liquidity to the market, that means the market has to come to you and then take your stop loss and then make you lose, and then you are automatically transferring liquidity to the market, just like that. The market will come to you. If you are the uninformed trader, the market will come to you, take your stop loss, then you are automatically adding money to the market. Then the market is now flowing with your funds. That means with your funds and the funds of the institutions. Do you see how you're adding liquidity to the market right now? So now there are candlesticks that the institutions, the big dogs, use to grab those liquidity. There are candlesticks that the institutions use to grab those liquidity. I've talked about those candlesticks before in our lectures. It is always inverted hammer or inverted hammer or hammer. These are the type of candlestick that when you see them at key levels, you will know that yes, this is actually a liquidity grab type of candle. You know. So now, we already know now that there is liquidity flowing all around the market, and there are liquidity at the equal top and the equal bottoms. You know. So now, and we are trading supply and demand, which means that we are trading what the big dogs are trading. That is why we are called the smart money traders. So since we are trading supply and demand, you already know how we draw our supply and demand zone. Now we've talked about liquidity, and we've talked about how the market is drawn to liquidity. You understand? So now we are trying to now equate our strategy with which is basically supply and demand, with liquidity. We are not entering kind of inducement. You understand? We are trading supply and demand. Then we need inducement to happen. We need the market to take out uninformed traders for us to trade. So we need the uninformed traders to add liquidity to the market so that we can come and trade with the institutions. So we don't always want to be the first person to trade. We always want that fake out to happen first before we trade. Okay? So if we should wait for manipulations to happen before we trade, that means we are waiting for that inducement to happen before we trade. Okay? So inducement is actually kind of getting liquidity from uninformed traders, adding liquidity to the market, and then going to the way of the institutions. So our demand is here. Let's take this as an example. This is a valid demand. This is a valid demand. This is a valid demand zone. This is a valid demand zone that broke structure. Perfect trade. You understand? But you've got some equal low candlestick here. You've got some equal low here. This place looks like a support. This place looks like a support. The market came down to take the stop losses of the people that are selling, that are buying at the double bottom, because the market already knows that there are traders trading at all double bottoms. So they come down to take them out and make them lose, and then give you a demand setup. At every if you want to draw a demand zone when you want to trade, one, you have to always make sure that the market has already taken out the stop losses of these traders that wanted to sell, or that had their stop losses below, just by the left hand side of your demand zone, because the fake out happens here. It is a fake out. So what this just meant is that the market was going down, went up, came down again. So there were people that wanted to buy already at this green candle. Hang on. So now let's say we've not already known. Okay, let's take this out. Let's say there was nothing here. Let's say at that time we had nothing here. Let's do so we saw something like a support here, though it's closed, so disrespected. So we were just here. We broke this structure. And we saw a demand. But why would you take this demand? All demands are not demand zones. All demand zones are not demand zones. All demand zones and all supply zones are not true demand and supply zones. There are true supply and demand zones. And the true supply and demand zones are the zones with inducement. Why are there zones? Why should there be zones with inducement? Zones with inducement add more potency or more authenticity to a zone. You understand? Your zone, the zone that you're taking, must have a liquidity attached to it. So one, you have to. Let me get this. Your setup must have to grab liquidity. It must have to grab liquidity. You understand? It must have to grab liquidity. If your demand doesn't have liquidity attached to it, then you're taking an empty type of setup. So when this happened, when you just had this at that time, if you see this, if you draw a demand zone, you always have to look by the left hand side, or just by the left hand side around this place. At the zone, what happened around here? You can also add what happened around here. You have to check if there are manipulations that happen there. Check if there are candles that took out, because we already know that there are liquidity at candlesticks. just like we said here, that there is liquidity at equal that at candlesticks. You have to check if there are liquidity that are being taken below candlesticks. Because if there are candles that are going below candlesticks, going lower than a candlestick, that means they are trying to take out traders that had their stop losses there before the market came. That is why they are coming lower than this low, just to take them out and then add money to the market, and then came down again. It is coming down again to get these people scared, and then it went out. So now the money that the funds that these people had here has automatically been added to this zone. So this place is now a very high probability zone. This is a true supply and demand zone with a gap. Do you understand what I mean, or what I said? Is my explanation kind of are you guys following me?
Please come again, sorry.
Okay, so I'll take it again. We know that there are double bottoms. There are liquidity at double bottoms and double tops, and there are liquidity at candlesticks, equal candlesticks. There are liquidity above and below candlesticks. So if there are liquidity below and above candlesticks, and there are liquidity at equal bottom or equal tops, that means, by liquidity I mean that there are traders trading there, and there are buyers. There are traders trading at equal bottoms, equal tops, and below and above candlesticks. Liquidity lies there because there are traders that are trading and putting their stop losses there. You understand? So now we always have to check if our setup, by our setup I mean by our demand or our supply zones, are taking liquidity, if they are adding liquidity to the market. You understand? We have to check if they are adding, if the trade we are taking, if the setup, the demand zone we are taking is going below a low. This is a low, this is a level, or below a level. This is a level. If you equate this is a level. If you draw this here, this is a level. So this candlestick, this red candlestick, closed below all the lows here. It just wanted to take out these buyers that were buying from this place. So now so when the market came down with this red candle and went lower than these lows, it wanted just to take them out and add liquidity to the market, and then went up. It came down again. Yeah, it came down here again, and then went with this green candle. That means this place is a true demand zone. I will still give more examples though. And whenever the market comes to a zone, just like I said, like a zone that took out liquidity, or it took out equal highs or equal lows, when the market comes back to that zone, it's usually it rejects the market very fast, because it is a true zone. It took out liquidity, it took out this equal low, added it to this demand, added it to this zone, it took out this money, these people's money, added it to this zone, this already demand zone. So this is a true zone, and that was why it rejected this kind of fast. You understand? So that is a true supply and demand zone, and this is the type of zone that you always have to take. A zone that have grabbed liquidity, a zone with a liquidity, a level a zone that took out a low. A zone that took out a low just by the left. This is a manipulation. So a zone that took out a low. So you always have to check the left hand side of the zone you're marking. If you're taking a demand zone, you always have to look at the left hand side to check if the zone that you're taking took out liquidity. If it took out a low, if you took out a low in a candlestick, I mean the liquidity sitting below 2 candlesticks on your zone, so you always have to check it, because these are the A class type of setups. I'm sorry about that noise. It's a power bike. so you always have to check if your demand zone took out a low. So that is for inducement on buying. Is that clear at all?
Yeah, clear. Thank you.
Oh. Okay.
Clear. It's clear.
So if you guys got any question, you can ask. So one, you always have to make sure that your zone took out liquidity, your zone took out traders, your zone took out an equal low or an equal high, your zone took out 2 candlesticks. You understand? Something like these 2 candlesticks. Always also check if your zone took out. So we will come to that when we get there. So that is for the buys. So let's check if there are inducements on selling. Please, if you guys got any questions, you can ask me. Let me look for sales here. Dropped again. Took out this guy. Dropped. Okay. So this is a supply, right? This is supply. This is supply with a gap, with a tiny gap. If you're checking the gap, this is the gap. So I'll show you the gap on this demand. One, you always have to take okay, these are the criteria for trading, taking a true demand or supply setup. We already have principles for taking a demand for making a demand zone. One, we say that one of the principles of drawing a demand zone is that your zone, you must have a setup which is a demand zone first, then a break of structure. You understand? We already said that if you have to draw a zone, a demand or a supply zone, you must have that demand or supply, then you must check where it broke structure. If your demand or supply does not break a structure, it is not a true demand or a true supply. It is not a demand. Maybe you were just drawing something like this. If your zone did not break a structure, that means it is not a zone. So your demand must break a structure. If it doesn't break a structure, it is not a zone. So now, if you are trying to trade an inducement, if you are trying to trade the real and the true supply and demand trading, your zone must have taken liquidity. It must have grabbed liquidity. You can call it liquidity sweep too. So it must grab liquidity. 2, it must break structure depending on the trend. It must break structure depending on the trend. 3, it must have a gap. It must have a gap on the demand. On the demand zone, it must have a gap. By having a gap, by your demand having a gap, I mean like when this candle came, we were here at that time. This was the real time candle. Then there was no candle that came back into the zone. When this we draw our demand just like the green, the red, and the aggressive buy. If this second candle that came out of the zone, if there was any other candle like the third candle, if there were any other candle that came to the zone, that came back into the zone just like this, then this there will not be any gap here. If another candle, when this demand was formed, when this demand zone was formed, if another candle came, like the next candle that was supposed to come, came and then entered into the zone, just like this, entered back into the zone, it is automatically filling the orders that this market left when this demand was created. When this demand was created, it had gap. No candle came back into the zone. But if another candle, the next preceding candle came back and entered back into the zone, it is filling the orders. It is filling the orders of the institutions, the big dogs that are here, already waiting to buy. You understand? So since there were no candlesticks that came back into this zone when this demand was formed, there were no candlesticks that came back into this zone when this demand was formed, it is automatically making this zone. It is automatically creating gap here. So which means that there is gap from this red candle that is on the zone to here. So we've got a gap here on the zone. So there is gap here. And the market, since there are gap here, the market would always want to fill in this gap. So this is a demand zone. This is the gap, because it's a gap because no candlestick came back and entered back into the zone. Okay, so let's play it. And so now it came down. So the next candle came, filled in around this place. So the next candle came and filled in here. So now we had from here to here. So we've got gap from here to here that the market needs to fill and then enter this zone. Remember, this is our demand zone. I'm just trying to show you how to spot the gap on your demand zone. Remember that I said 3 principles of trading trading through supply and demand. 1, it must grab liquidity, which means that it must take out an equal low or an equal high. An equal high for supplies and equal low for demand. Then 2, it must break structure. And 3, it must have a gap. Okay, so I'm trying to show you the gap on the market, when the gap that formed when this demand was created. So remember, it had this whole full gap here. It had this whole full gap here before the next candle came down. When it came down, it filled from here to here. So there is gap here. You understand? So it didn't come back again to fill in this gap, So the next time it came back, it's filled in the order. It's filled in this gap. It's filled in this gap. This gap is from this place you marked the zone, from the red candle to here, that is filled before it left, and then came back again, filled it in, and tapped into the zone, tapped into the demand zone, and then left the zone. So now you have, that is why when it came down, when it came to this zone, it just filled the zone, tapped into the demand, and then left the zone. So it is a strong demand zone because it has all these components. Like it has all the clean and the perfect components of a true supply and demand zone. You understand? So that is a gap in the market. That is a gap on the zone. So you have to always make sure that your zone, your demand zone, has a gap. If it doesn't have a gap, don't trade it. If the next candle that came here before all this movement happened, if the next candle came and filled it in and came back and tapped the zone again, that means this will be a filled order. It will be a 50-50 chance that your trade will hold. So if you're trading any type of demand, you're just trading a 50-50 chance that your trade might or will not hold. You understand? So this type of setups gives you more confidence to take a trade. Like trade that has this component: peak liquidity, taps liquidity, has gaps, broke structure. You understand? You don't have to be taking any type of setup because nobody likes losing money. You understand? So you shouldn't be taking any type of setup. You must and always take setups with gaps, setups that grab liquidity, setups that broke structure. You understand? So this is a perfect example of the true type of demand setup that you have to be taking. So let's go to this supply. So have you guys got any questions?
No, I'm good.
Okay. So
now, can you take the trade when the criteria is only 2 or 3 positions?
I didn't hear you. Please be audible. I can't hear you, please. Hello?
I said, can you still take the trade if it doesn't meet those 3 criteria?
No. There's no trade.
Okay. I think what he meant is that if you meet like 2 criteria, can you take the trade like that?
If you've got 2 criteria without the trade.
Yeah. Yes. That's what he meant.
I don't think it will be advisable taking the setup if it meets just 2 criteria. But that would have to. Okay, I have actually discovered that sometimes when I am trying to make you taking this type of if you've got 3 criteria all checked off, it increases the probability of the trade hitting.
Yes.
You understand? But if you're taking the one that 2, you understand? By 2, I mean by this zone would have been filled before it left, which means maybe having just 2 criteria. It is under probability. Yes, it might hit sometimes, but the more the one that would hit more would be the one that
it will have less win rates.
Yes. So these are the true setups that even the banks do trade. Like this is inducement. Like this is the game changer. You understand? So you have to always wait for that fake out, for those people for the uninformed traders to add money to the market, then for you to take the trade. So you have to always check this and also know the trend. So because by the trend you're already having the break of structure. So these 3 checks have to be done. So if you're on checking 1, that means you'll probably be eliminating gap on the zone. By gap, I mean by if another candle came here to fill in. But if you're trading normal break of structure and that the market took out the low and then gave you a demand, but without a gap, it doesn't mean that it wouldn't hit. You understand? But it's a filled order. It's just a filled order. You understand?
Yeah.
So have you got any questions then?
No more questions for now.
Okay. So now we're heading to sell. Yeah. So now the market is breaking structure to the downside. Broke this structure. Broke this structure. Broke this structure. So it came on. But if you look at the supply that you took, does it have the three principles, the three checklists that we have to do, we need on this this setup now?
Yeah. But look at this didn't grab a lot of money from this.
Yeah.
You understand?
Yeah. So look at
it didn't grab like it at the close of the close of the green candle. At least it took like it went above the close of the green candle by your left.
here,
No, not that one. The other side.
this side.
It means no, the other one. Like I don't know. Yes, that side. This dodgy them, all this dodgy and
Yes. You got it
Yeah.
perfectly. So the manipulation occurred here. So now this was the manipulation occurred here. So this zone that I marked, this is the supply zone that I marked. You understand? This is the supply that you already marked. You understand? So now, first, what happened here is that they went up, came down. So this red candle tricked traders, the early sellers, that the market was already going down. So if you mark a zone, check if there are movement, if there are opposite type of movement that happened in the market. It is called a base, a base drop, or a base drop rally, something like that. So this first drop lured sellers in. The early sellers, it lured the early sellers in that the market was already going down. And remember, this double candle now. It is an equal low, an equal top, a double top, or equal candlestick, something like that. When I was explaining those liquidity at above and below candlesticks, so there are people that are already selling here, and there are liquidity that are here too. On this candle, just at the opposite here, there are liquidity sitting above here. You can put it here, anywhere, just anywhere. So now they came down. Those people were already selling. They came down, then they went up again to take these stop losses. They dropped, they came up again to take out these stop losses, and then dropped, and then sold just like they predicted. Do you understand what happened? They first tricked them, then went up again, because you already have equal top, double top here, or equal based on candlesticks. You already have selling here. So they came up with this green candle just to grab these people, and then dropped. So that was why, one, these people have already added more liquidity to this zone, to this selling zone now. They already added liquidity here. Why is this thing not clicking? Oh fuck, why? I have to reload this and know why. I don't know why my SMATONI is failing. I don't know why my stuff is not clicking, giving me the right stuff. So you understand what I mean? So now these people, it took out these people's high, the people that were already selling. It took out these people's high, the people that were already selling. So this candle just went up here to grab this one and then added their money to this zone and then it sold. So that was why when it came back into the zone, you could see the type of rejection it just gave this thing. It just gave this thing on the supply. You understand? Because when they when they went up again to grab this high, they took out people, they took out stop losses, added the money to this zone, and then made it stronger, and then make it a true supply zone. They took out a high, they took out highs, and then dropped, breaking structure. So one, they have liquidity, they grabbed liquidity, they broke structure, and three, it had a gap. The gap is here. This is the supply. This is the supply. The gap is from here, that green, to here, where this red stopped. This is the gap. That is the gap. Look at this gap here. That is the gap. If you cover here, if you come back, can you see the gap? So it came back again, filled in the gap, tapped into the zone, and then left the zone, which is making this a true supply zone. It had a gap, it took out liquidity, broke structure, had a gap, it came back, tapped in, and then dropped. So that is so you always have to check if your setup, if your supply or your demand zone took out liquidity. Check the zone, check where you're marking, check the highs, check equal candlesticks, check if there are manipulations that occurred at that level. Check if there are manipulations that occurred at that level, so that you will know if you're taking a true supply or a true demand zone. Don't just take supply and demand, or don't just trade supply and demand just because you're trading supply and demand. So always make sure that your setup has got a gap, grabbed liquidity, and broke structure going with the trend. You understand? So this is a true supply. And if you want to place your stop loss, then you can put your stop loss above the candle and then take the break. But it depends on how you're trading or how you're putting your stop losses. So that is it took out liquidity by the left hand side, and here it took out liquidity also by the left hand side around. So you have to always check the other side of your zone to make sure that the market is taking out or it did take out a high or a low. You understand? So I would like questions.
Okay, I have a question.
Okay.
Hello. Yeah, good evening, everybody.
Yeah.
My question is, I've noticed, does it have to be a candle close or wick that takes away the liquidity?
If it's a candle low.
If it's a candle close or wick.
Okay, yeah, it can be
It doesn't matter which one.
No, it doesn't matter. It doesn't matter.
Okay.
It can be a full-blown candle, but just check the place. Just check if they came down and then left again. You understand?
Okay.
Yeah.
All right. Thank you.
You're welcome. So let's see. Let's check if some of the trades I have to go on 5 minutes. Let's check 5 minutes time frame. Session. So let's check if we've got any Let's check if we've got any examples here. Okay, let's use this as an example. Let's use this as an example. So here, the market was breaking structure to the upside. The market was breaking structure to the upside, and let me move some more. So the market was breaking structure to the upside, and making highs. Yeah, breaking structure to the upside. I don't know who was talking about. So the market was breaking structure to the upside and making equal higher lows, breaking structure to the upside. Then this was the place you were at this point. This was when you were trading. You can see that the market was making double or equal lows on candlesticks. These are lows. All these are lows. These are lows. So the market was making equal lows. It is making equal lows, just like what we talked about. It was making equal lows and breaking structure to the upside. So now this red candle, did you see what this candle made? It was red and then it was green. Just look at it. Red, green. So it took out these stop losses here. It just came down here to take out everyone that had their money here. Everyone that was already buying here. It just came down, it just literally came down here to take them out and then left the place. Now creating a demand zone. Remember, you can use one or two candles, maximum of 2 candles. You can put your demand zone at this red candle, or you can put it at this candle. So but just maximum of 2 candles. So they came down, grabbed them, and then left, creating a zone, a demand zone with a gap. So the gap is from here, from this red to here. This tiny stuff here is 1 minute. Let's check 1 minute and know if I don't know if I'll still get 1 minute, but let's check if they'll still have 1 minute. Okay, let's check 30 seconds. This will be it wouldn't give me a second. So but this tiny stuff is a sell on a lower time frame. So sometimes when you can't see stocks, you can go to a lower time frame and check it. So this is the gap. If I had this zone here on this first red, my gap will be from this red to here. From this red to here. Remember, this is the gap, not the back side, but the front side. That is the gap. If I had my zone here, this will be the gap. So now we still got the gap on this zone. 1, it grabbed liquidity. 2, it broke structure. 3, it had a gap. So we are on check, like everything is perfect. So let's see what happened. It came, filled in the zone. It came, filled in the gap, tapped into the zone. Then you should be buying, taking the break of the signal candle, your stop loss below. You can put it closer or just anywhere, but you already know that Yes, they've got the money. They've got the money here. By first, this already has the money. Adding these people's money into this zone, making this zone a very high efficient zone. You can see the type of rejection it got when it came back into the zone. One, it filled in these orders with this red candle. It filled in the gap, tapped into the zone. You have everything in check, So that is and then you hit your take profit. So that is what happened. So you always have to check your the demand zone you're trying to take. Check if it grabbed liquidity with it. Check if it is breaking structure, and check if it has a gap in it. If it doesn't have a gap in it, no trade. If it doesn't grab liquidity, no trade. If you're not following structure, no trade. You understand? So you have to always make sure that your trade has a meaning. If your trade doesn't have a meaning, you're not trading. If your trade doesn't have a meaning, you're just taking a buy. You're just hitting buy and sell button. You understand? You're just hitting buy and sell. We are not gamblers. We are traders. So you have to make sure that you're differentiating gambling and trading. So even if you had your zone here on this gap, they filled in all the others and they filled in all the gaps and left. So even if you had it here, so they filled it in. But this is a high efficient type of trade. Don't just take any setup. Don't just take any supply or a demand setup. Take the high efficient type of setups, so that no one likes losing money. So this is an inducement. So this thing that happened here, this red green that happened there, this taking off these stop losses, is that inducement, because it is taking out people, the first buyers. It is taking them, the first initial buyer, taking them out, adding their money to the market, leaving the zone, then came back, tapped into the zone, and then left, gave you your money. You understand? So this is yeah.
So I wanted to ask about the first ball you circled on the candlestick. The first one that took in the zone. No, down. Sorry, down. The last level. And this no.
This one.
But yeah, this one. I wanted to say it took out the low here, but it didn't break any structure up. So that's why I said the zone wasn't valid, because it looked like a good demand zone.
Yeah, okay, you mean by this demand?
Yes, it looked like a good demand, but it didn't break any structure up. So I just said, oh, okay.
Yeah. There was no structure, bro. Yeah. So it took out, this came down to took out this low here.
Yeah. That's if it was carrying the money along.
Yeah. So it went lower than this low. Took out the people that were already here. So went up. So yes, it took out the liquidity and gave higher highs. So have anyone got any questions? So let's check another setup and know if there are other setups you've got. So always watch out for these type of candles. Always watch out for these type of candles. These type of candles are liquidity grab. So always check your zones and check if the candle is just trying to take a high, or if the candle is just trying to take a low. So these are the things you always have to watch out for. Check if they are taking a high or if they are taking a low. Just check what they're doing. Let's check if. Okay, let's see something like this. It went higher than these ones. We can have. You can see in this situation now, it's not a wick, it's just a candle. Then it gave the supply with a gap. It tapped in and then dropped. You understand? So now it went all the way up here to take out these highs and these highs, then gave you that supply. So it added more money to this zone. and then when it came back, it tapped and then dropped. So that is, these are, and then broke structure. So everything is it just makes sure that everything is aligning to the trade. Took out liquidity above here, came down, broke structure, has a gap, filled it in up to here to here. It had a gap from here to here on this candle. It came, filled it in with this one, then we had this one left, we have this more left. It came down, came here again, then filled in all the candles, tapped into the zone, and then left the zone. So these are high type of trade. One, it must have a gap. Two, it must take liquidity. Two, it must break structure. Three, it must have a gap. So your trade always have to make sense. So this is for sell. You understand? So, and the last one we just did was just for buys. So if you guys don't have any other questions, we will be calling it a day. So do you have any other questions? Does anyone have any other questions? So I'm going to say that silent is consent.
Yeah,
Yes.
I have nothing. I'm good.
Okay.
100%. 100%.
Okay.
Alright.
Okay, so guys, you have to always know, like, make sure that you study this. Don't just take a setup. Make sure that your setup is aligning with everything. Make sure that your setup is aligning with just everything you're saying. Make sure that your demand or your supply zone grab liquidity. Make sure that you're riding with the big dogs. Make sure that you've got money. Trade the zone that has money. Don't just trade an empty zone, because liquidity is stronger. Liquidity is more stronger. So trade with the ones that have the money. Follow the ones that have the money. Follow the money. Follow the flow of the market. Whenever you come to the market, check where the money is. Then follow the money. Your zones, mark the zones with liquidity. Don't just mark any zone. If it got no liquidity, no trade. If it got no liquidity, no trade. So you have to constantly practice this thing to keep saying it. This is a very high, it's a high efficient type of trading. This is the true supply and demand trading style, strategy, everything. So you have to constantly spend at least, give the screen your time. Study back to back. Make sure that you're saying it. If you've not seen, if someone you can ask me questions on the Discord, so that we'll talk about it. So you can't just sleep and expect this thing to enter your head like that. It can't enter. So that's just it. So I'll see you guys on the chat. Okay.
Alright, good night.
Thank you so much.
You're welcome.
Thank you.